Welcome to this lesson on leveraged investing, where you'll learn about using borrowed money to amplify your investment returns. Leverage is a powerful but risky advanced investing strategy that can significantly impact your portfolio. Throughout this lesson, you'll discover how margin investing works, understand the serious risks involved, and learn when this approach might or might not be appropriate for different types of investors. Leverage means using borrowed money to invest, which amplifies both your potential gains and potential losses. Think of it like this. Instead of just investing your own cash, you're borrowing additional funds to control a larger investment position. This means you're essentially controlling more assets than your own capital would normally allow. The key thing to understand is that leverage works in both directions. It magnifies your profits when things go well, but it also magnifies your losses when the market moves against you. Let's break down the core components of margin investing. First, you need a margin account, which is a special type of brokerage account that allows you to borrow money to purchase securities. Second, there's the margin loan itself, which is the borrowed funds provided by your broker. Your existing investments serve as collateral for this loan. Third, and this is crucial, you pay interest on the borrowed funds. These interest charges are typically variable rates that can change over time. The interest you pay reduces your overall returns and adds an ongoing cost to maintaining leveraged positions. Let's look at a concrete example of how leverage amplifies returns. Without leverage, if you invest $10,000 of your own money and the stock increases by 20%, you gain $2,000, which is a 20% return on your investment. Now, with 2-to-1 leverage, you invest that same $10,000 but borrow an additional $10,000 from your broker. When the same stock increases by 20%, you gain $4,000 on the $20,000 position. That's a 40% return on your original $10,000 before accounting for interest costs. Notice how the leverage doubled your percentage gain. Now let's examine the dangerous side of leverage. Using the same example without leverage, if you invest $10,000 and the stock decreases by 20%, you lose $2,000, a 20% loss. However, with 2-to-1 leverage, when that stock drops 20%, you lose $4,000 on your $20,000 position. That's a 40% loss on your original capital, and you still have to pay interest on the borrowed money. Even worse, if losses continue, you could face a margin call, which forces you to add more money or sell your investments immediately. The leverage that doubled your gains also doubles your losses. There are 3 critical risks you must understand about leveraged investing. First, margin calls occur when your account value drops below maintenance requirements. When this happens, you must immediately add funds or sell assets, often at the worst possible time. Second, interest costs continuously eat into your returns. During market downturns, these costs compound your losses because you're paying interest even as your investments decline in value. Third, forced liquidation means your broker can sell your positions without your consent to cover the margin loan. You have no control over the timing or which assets get sold when your account falls below minimum requirements. Brokers impose 2 key margin requirements you need to understand. The initial margin is typically 50%, meaning you need at least 50% equity to open a leveraged position. So if you want to buy $20,000 worth of stock on margin, you need at least $10,000 of your own money. The maintenance margin is usually 25%, which is the minimum equity required to keep your positions open. If your account value drops and your equity falls below this 25% threshold, you'll receive a margin call requiring immediate action. These requirements exist to protect both you and the broker from excessive losses. Leverage might be appropriate in very specific situations. First, experienced investors with a deep understanding of markets, risks, and portfolio management strategies may use leverage tactically. Second, for short-term opportunities where you have a specific investment thesis, a defined exit strategy, and clear risk limits, leverage could potentially make sense. Third, you need a strong financial position with sufficient capital to handle margin calls and absorb potential losses without jeopardizing your financial security. Even in these cases, leverage should be used cautiously and represents only a small portion of an overall investment strategy. Most investors should avoid leverage entirely. Beginning investors who are still learning market fundamentals and building investment experience should absolutely stay away from borrowed money. Long-term buy and hold investors should also avoid leverage because interest costs and volatility risk undermine the compound growth strategies that work best over time. Finally, anyone with low risk tolerance, those who cannot afford significant losses, or those who would lose sleep over portfolio volatility should never use leverage. The psychological stress and financial risk simply aren't worth it for the vast majority of investors. Let's review the essential points about leveraged investing. First, leverage amplifies both gains and losses equally. There's no way to get the upside without accepting the downside. Second, margin calls can force you to sell at the worst possible time, often locking in losses during market downturns. Third, interest costs reduce your returns and compound your problems during downturns because you're paying to borrow money even as you're losing it. Finally, and most importantly, most investors are better off avoiding leverage entirely. The risks typically outweigh the potential benefits, especially for those building long-term wealth through patient, disciplined investing.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.